Thank you so much for taking the time out for joining us today. And thank you to Peter and Orin for joining us.
Well, thank you very much, Sean. We have a presentation to go through some of the macro aspects of this crisis. And then we will go into some of the more equity-specific issues, some of the stocks that we've selected are interesting at this point with Orin. So just to kick off, we at Intellidex are supporting easy equities in terms of the research that we produce, the thought leadership that you'll read from us every month. We also have a much larger business around the back of that in terms of supporting businesses across the JSC boards and C-suite level, talking a lot to them about strategy, about political economy issues as well. And so we're well stuck into thinking about how this crisis is impacting business, impacting companies and the stock market, and also thinking about the recovery plans to come as well. So going into some of the political economy and macroeconomic background, I think it's important to first think about the issues that are really playing in terms of this crisis is the speed with which the virus is reproducing. It's the death toll that is slowly ramping up. And I think the key thing here is that the market doesn't fully appreciate, at least not until very, very recently, that we're not really at the peak of this crisis at all. We've, of course, had the lockdown. South Africa moved significantly early versus other countries in terms of locking down before the first death had occurred at the end of March. And as a result, we've had a long period of deep economic impact, of course, but actually we're not at the peak yet of the outbreak. Of course, most countries in the Northern Hemisphere are only just starting to come out of their lockdowns as they see the total outbreak start to fall, the number of deaths fall. But South Africa is quite unique in this respect. If we look at the graph on the left-hand side, this is basically the amount of time it takes to double the number of deaths in South Africa cumulatively, and that's been sort of bopping around 12 days since basically the middle of April, and has shown some remarkable consistency actually through this time. We can see it's the number of days has risen as lockdown was put in place, as behavioral changes happened, social distancing happened, but it's been pretty steady since then. And whilst the number of deaths increasing has been quite slow per day in terms of numbers, we should remember it's still doubling every 12 days. And as we get to larger and larger numbers going forwards, as we reach then a peak of the crisis, the Department of Health expects at the end of August or the start of September, I think the politics of this, the market dynamic, is going to be quite different as a result. The right-hand graph shows that the number of deaths as a percentage of the total number of cases has actually again been remarkably consistent. These different lines are comparing the death rate to the number of cases today. That's the orange line, the green line 7 days ago, and the yellow line there is 14 days ago. And these numbers are remarkably stable, as you can see, through since the middle of April. And looking at the comparison to 14 days ago, at about 4% there, that's actually very low versus a lot of comparisons and peers. Most cases in Europe are around 18 to 20% on that, some as high as 40% even, depending on how people measure. I think this really shows that South Africa is actually doing pretty good measurement of the crisis, of a huge community effort going on that front. But it also shows, I think, that there are some differences in South Africa, a younger population coming through as well. But it also shows as the number of cases rise and continue to rise, we still do expect a small, but obviously a significant and regrettable number of people passing away from the COVID illness. And I think the point to take away from here is that things will appear somewhat different as we move forwards. Now, these are the graphs, the modeling that the Department of Health is really looking at. And it comes back to this point. We're currently on if you look at the bottom right-hand graph, that's cumulative deaths. We're right at the very start of it there, and there's a long way to go. The Department of Health projecting around 40,000 cumulative deaths by the end of the year. And clearly the peak run-up in that is due to happen through July and August, when I think by these numbers at least, you would see maybe 1,000 people dying a day. I think, again, that raises a lot of questions about what happens with the lockdown. Do you have to go back to higher level lockdowns? Not that it necessarily has much use, but because it would basically be politically the right thing to do to show some reaction as the crisis morphs. Now, these levels may be somewhat too high. There is some criticism of this modeling the Department of Health has done. It maybe downplays some of the behavioral changes that have gone on, people socially distancing, people wearing masks in public, and some of the forecasts maybe make it show it's a little higher. Maybe 20,000 for the end of the year is a more appropriate number to think about. But I think the important thing here is more the shape than necessarily the endpoint, and how it will play out through the next 2 to 3 months in particular. And that's this idea of waves really coming through that we are interested in. The moment now is this false dawn, if you like, where we're seeing an end to lockdown. We're seeing the economy starting to get going. But I think a lot of risk aversion from companies, a challenge to meet the health protocols that are put in place, the very necessary health protocols, which basically means that we have to, we're seeing still a very severe drop in output versus normal. If we look at very high frequency data like electricity demand, that's still around 10% below normal at the moment. And so, there is still a GDP impact going on. There's still a loss of output going on. There's still unemployment occurring, and despite the fact that we are coming out of lockdown. But as I said, we go into this sort of peak pressure point where maybe we see between 500 and 1,000 people die per day. The politics then maybe insist on a lockdown coming back because you can't do other things. Maybe we haven't got ICU bed capacity up to where it should be. And so another bigger hit coming through there. And when we think about all this together, there's still a big loss of output for this year, even if the peak of stage 5 was only for 3 weeks. We see the total loss of output this year still with growth down as around 10.6%. That's a little higher than the SARB. They were saying around -7% at the last MPC meeting. The National Treasury has come out with scenarios saying -6, -12, or -18%. But we're happy with that kind of number. We think it makes sense versus what we're seeing and talking to different sectors about how they've reacted. And we think actually a lot of those other forecasts are from consensus, from banks, from the SARB, are moving out towards our kind of level as well. Now, that kind of growth forecast is based on a pretty slow recovery in growth from the loss of output being quite sticky because of things like unemployment, firm destruction. And that's a sort of long tail of some recovery that we see from September to April next year. But a lot of risk in that period as well to think about in terms of the economy, in terms of society, as well as things like the temporary unemployment benefit for furloughed workers from UIF rolls off. The temporary grant increases may roll off, though the government may decide to keep them on. The interest-free loan period as well for banks rolls off as well through in 6 months' time. So a lot of risk of additional contraction and negative force coming into the economy, even through this recovery phase, which I think we need to be cognizant of, and hence a very long tail to this crisis. But we need to also think about what happens next year. There could well be a second wave of this crisis. Now, that's somewhat uncertain. There's a lot of debate around that at the moment amongst scientists if this happens. But it's certainly a risk that we need to be cognizant of, in particular because there's very little left in the kitty in terms of the ability to apply more fiscal stimulus, the ability for the SARB to cut rates significantly further. A lot of these measures have happened already, and there aren't those buffers really to come through next time around to provide an additional stimulus. So we need to, I think, be quite cognizant of a second wave, in addition to the fact that we're not to the peak of the outbreak at the moment. And so if we follow through these problems for the future, really, we're thinking about a sustainable recovery is ultimately only going to happen when you can have enough fiscal space to support the economy, when you can have enough nominal growth that creates that revenue for the government to undertake spending, undertake support into business, that we can repair balance sheets as well. And that's why we're looking for this sort of 8% nominal GDP target as we go into the recovery. But it's quite hard to see. South Africa, of course, has really struggled to get real growth rates above even 1% in the last few years. That's nominal growth above really sort of 5%, 6% has been a real struggle in the last few years. But government, of course, also has many political constraints around forming a recovery plan. And that's really what's happening in this week and the next couple of weeks, is going to be an attempt to reform a recovery plan, but that will probably be quite politically compromised, and compromised as well in terms of the capacity of the state, the amount of money that can be spent on this. And I think that's really where we have to start thinking again about these issues of sticky long-term unemployment and these cliff edges as well that will also come through. But if we don't reform and South Africa isn't seeing higher growth, then there is only basically one direction really left. Someone ultimately has to help South Africa fund itself. The SARB can provide a free lunch, in that case by buying bonds directly from Treasury. They're resisting that at the moment, but ultimately, if push really came to shove, maybe they would have no choice. But countries at the end of the day always have to reform. They always have to have higher growth rates, or else politically there is obviously a big backlash eventually against that, and also societally as well. Countries do not manage to run negative per capita income growth as South Africa has since 2012 for very extended periods of time without deep unrest coming through. And as a result, South Africa eventually is going to have to reform itself. If it can't do it itself, it's going to have to rely on others to force it to do so. And that's where the discussion around the IMF really comes in. And in particular, the use of an SBA, a standby arrangement, or similar, where South Africa gets access to a very large amount of money in return to making commitments to reform to get that growth, nominal growth level up to about 8%. But if South Africa doesn't want to go down an IMF route with conditionality around reform, then there's always China, and China has come up in the debate somewhat in the last couple of weeks to provide support for South Africa. But I think it's often misrepresented. China wants the same things as the IMF in terms of sustainable state-owned enterprises, a dynamic labor force. It wants countries that grow ultimately and strong trading partners for it to invest in as well. And so in reality, the Chinese route is actually not very much different from the IMF route, and I think is a point of mischaracterization often in the South African debate. But the overall point here is that South Africa ultimately has to reform itself to get out of this crisis, and will either do it itself or be forced to by others. But currently, I think the problem we're really facing is that I've talked a lot about long, sticky tails of this crisis, potential stickiness in terms of job losses, maybe up to 2 million jobs lost permanently through the end of this year. But the markets are pricing is V-shaped. Now, this graph is somewhat overlaid with information, but the key things to sort of look at here is that we've turned the equity indices upside down. So down is actually better. We can see the shock, the negative shock coming through as bond yields spiked higher through the end of May. That's the orange line. As the S&P, the white line, and the JSE, the purple line, sold off. And then the currency sold off as well, dollar rand moving much higher from around 14 to up to 19, just over 19 at its peak. But then we can see we've seen a big fall back in bond yields, back to basically where we were before this crisis happened. And the JSE and the S&P have now regained almost all of their losses as well. And we seem to be pricing some sort of V-shape recovery that we think is unrealistic in terms of the global recovery. That's the style of offshore demand and how other countries recover, but also in terms of the South African domestic economy and its recovery, given the deep structural problems around labour markets, in particular around access to funding, around the lack of fiscal space to provide much stimulus. All this we think means a V-shaped recovery is somewhat unlikely. And that's really going to be this battle between markets, in particular equity markets, and the reality of the macroeconomic data as we go forward. So let's get some here, and Orin will talk a bit more about some of our picks, given this sort of misalignment that we see now. So over to Orin.
Yeah, they're going to see a lot of pressures in margins and profitabilities, and when the numbers start showing that, we probably going to see investors are starting to factor that into their valuation. And when that happens, probably that's when I'm going to see the second dip in terms of equity markets. If you can go to the next slide. All right, so what we're doing, we, given that backdrop generally, we've been trying to assess the vulnerabilities of various equity sectors on the JSE. There is no easy way for doing it quantitatively, but what we've been doing is look at three important issues. We looked at current financial standing of a sector. So here we've been looking at the gearing ratios, the debt levels of each sector. We're looking at the profitability, measuring by return on capital employed. We looked at interest ratio, which basically shows the ability of companies to meet their obligations, as well as a quick ratio, which is a ratio that looks at the liquidity of the company. So that was one set of it. The other part, we looked at the cyclicality of JSE sectors. So we're trying to gauge the responsiveness of each sector to GDP numbers. Which sector is most affected when it comes to GDP? And the other factor that we looked at, the third prong, was on growth. So from what you see on the slide there is the results that we got on cyclicality. So here we're looking at economic betas, which is the coefficient of regression of a sector GDP to the national GDP. So generally, if you've got a beta of above 1, it means that you are, sort of sensitive to economic growth. But if the beta is, say, between 0 and 1, then the sensitivity of that particular sector is not as extreme. So what you can see from there, if you look at the blue line, so that is the economic beta, and it points to consumer discretionary sectors as the most sensitive. So we have got, I think, a factor of around 4.6 on the clothing and apparel retailers. So if you just want to use that to project, you're essentially saying that for every 1% movement in the GDP, you should be expecting something around 4.6 movement in the GDP of that particular sector. So if you multiply that, if you use linear regression to project into the future, you're looking at a decline of around 40.6%. Of course, there are other factors that come into play, but if you're using that as a single projection indicator, then that's the kind of decline that you're looking at for the clothing and retail and the retail sector. The other sector that also doesn't do well on that is the travel and leisure. Again, it's because these sectors, they speak to sort of consumer discretionary. Then most of the other sectors which are within the factor of 1 shows that they've got a bit defensive. Then the red line there shows the equity beta, which is basically a regression of the index share price versus the stock market share price. So I think as you can see there, you find that a lot of sectors are generally within 1, which means that they move in line with the stock market. So what we got from this exercise really is we found that there are certain sectors that seem defensive, and these are the sectors that we're saying probably if you're going to take a top-down approach, these are the sectors that you might want to look at. And we find food producers generally as a sector being very defensive. It does well on the economic beta. It does well in terms of profitability. It's coming up from what we think was relatively strong business cycle, especially if you look at chicken producers. They've been doing well quite lately, so their balance sheets are quite strong. The other sector is, it's not really a sector, but SIM stocks. So these are, they're usually defensive when it comes to recessions. When you talk about tobacco and alcohol, and I think you probably know the drivers behind those is because the demand for their products is usually stable, no matter what. People drink and smoke. Then also you have the healthcare sector is also under defensive. Then the sectors that we see as the most vulnerable at the moment, travel and leisure, I think the reasoning behind that sector is quite straightforward. It's one of the sectors, if we look here in South Africa, which is still under lockdown. They're operating, some of them, but the level of operations is quite low. Probably they just are being allowed to take business clients or things like that. So, and the other sector is the consumer discretionary as the most vulnerable. I think I've touched on this, which is the clothing and retail. Then we've got banks. So for banks, when it comes to the numbers that you crunched, you'd find that they've got a very resilient economic beta. The banking sector doesn't usually, go in line with the economic growth. When you look at the revenue, that's the nature of banks. But their profitability tells you something else. So usually, when the economy is not doing well, what you expect is increases in credit losses, and that usually eats into the profitability of banks. So that's what we're looking at in this case. Same applies to insurance and property. For insurance companies, they've got a lot of interest-sensitive products. The same with banks, and those products are going to not do so well in a low-interest environment. Then we've got another group that we just came up with that's referring to as dark horses. So essentially, we're saying these, according to the modeling that we did, these are the sectors that are vulnerable in a way. But there are certain things that are happening in those sectors that could actually result in them doing well. So one of them is the construction sector. I think Peter has talked about the Fed stimulus. And within that stimulus, it looks like the ANC is going to prioritize infrastructure build. Yes, it's not the first time that the ANC has talked about this, about putting a lot of money into infrastructure. In times it doesn't pan out. But we're quite encouraged by the fact that they're not necessarily planning to go alone, as a government, but they're also trying to bring in the private player through triple Ps. And we think that could actually bring new money into the sector. So if that happens, we're thinking, in the construction sector, we might actually see some companies doing all that. Then we've got telcos. Telcos generally are GDP driven. But again, we have seen, prior to this, there was a transformation in the sector whereby voice revenue was declining, and most of the companies were trying to push data, to compensate for the decline in voice revenues. So the outbreak of coronavirus might actually have speed up that transformation. We expect that maybe voice revenues might continue declining, but there is a potential that people working remotely, like what we're doing right now, there is a potential that people using more data that might actually support growth within telcos. And then on the mining sectors, we all know that mining commodity prices are heavily linked to the global economy. So that's the advantage of the mining sector, not the South African economy. So when you look at those two, the global economy versus the South African economy, we're expecting a decline in the global economy, but we think that it might actually rebound faster than the South African economy. And if that happens, then you might actually see the mining sector recovering potentially faster than other sectors within South Africa. So I think for each of these sectors, we've also picked some of the stocks for those who might interested in individual stocks. So we, on the defensive part, we have got Astral, BAT, and Aspen. Astral is not a usual pick, probably. I think within the food producers. Well, the most what would want to pick there probably is Tiger Brands, because it's quite diversified and it plays it just got a scale, things like that. But I think there are quite a lot of problems with Tiger Brands that everybody's aware of right now. So we have to go with our second choice, which is Astral. Then on the SIN stocks, we have got Abinbev and BAT, but Abinbev, we feel that consumer, demand for alcohol generally at the moment, simply because their distribution channel, which are bars, hotels and restaurants, are not functioning in some of the markets. You might actually see a massive decline in the sales of alcohol. I think Abinbev has already indicated that it's probably potentially looking at something like around 20% decline. So that's the reason why we couldn't pick it there. Then on the dark horses of the Vodacom, basically because I think they've got a very strong balance sheet in that sector. And secondly, they're operating outside of South Africa, they're operating in more stable markets where they can be able to extract cash, if they are subsidiaries do well, which is not the same story with MTN. I think MTN is operating some of the problematic markets. And then on mining, we're looking at Kumba Iron Ore, simply because iron is geared towards China, and the decline in China we don't think is going to be as extensive as in other markets. So we might actually see iron ore remaining a little bit stable, and also the problems that are happening in Brazil, which is one of the biggest producers of iron ore, would actually support iron in that case. So that's why we picked Kumba Iron Ore. Then in terms of ETFs, there's no easy ETF. The problem we have South African market, unlike in the US, where you probably have got an ETF for each sector. In South Africa, we don't really have that. So we've got these three broad ETFs: the financials, the one which follows the industrials, and the other one which looks at the resources. So those are the sector ETFs that you have. And when you look at the financials, they're not granular. So you find that the financial contains banks, contains insurance companies, and probably property. So if you've got a strategy which wants to focus on the property, you probably won't be able to use that particular ETF. But we're basically saying, if you want access to the ones that, to the sectors that are in the defensive pool, as well as the dark horses, you're probably looking at the quality ETFs that we have on the JSE, the industry, the Indy. It's got also good amount of those sectors. And the top 40 generally. So the top 40 has got these round edges. A lot of companies that are exposed to offshore markets. They also have a lot of the sectors that we've mentioned as defensive. So yeah, I think that's it. Thanks, Peter.
Thanks, Orin and Peter, for that insightful presentations. I thought it gave a great holistic view of what's been happening and some insight into what might be happening. So thanks so much, guys. We have lots of questions coming in, so I'm going to hand it over to Peter and Orin to try and go through those. We under a bit of time pressure to get through all of them, but I'm sure the guys will do their best. We do see a few guys asking about if the presentation will be emailed out afterwards. Yes, we will definitely do that, so don't worry about that. Over to you, Peter and Orin.
Great, thank you. So yes, a huge volume of questions. So, but they keep on coming. So there were some questions, first of all, about the virus itself, and sort of issues around why it's looking quite different in South Africa. The most underplayed issue from the sort of discussions we've had with people like the Financial Analyst modeling group and the other epidemiologists we're talking to is this idea of seasonality, and that the cold weather in particular is important for how the virus progresses, but also the fact that it's just simply the easing of the lockdown is then allowing faster spread, but doubly so expressed through the seasonality and the weather. But that we'll also see quite different peaks around the country. There's a huge volume of modeling that's gone on behind the Department of Health work, which shows a lot of very differentiated curves throughout different regions, for instance, which are going to see, I think, slightly lower peak as a share of population in slightly inland areas like Gauteng versus Eastern Cape and Western Cape, which are much worse hit. But I think the interesting part as well, of course, is given testing. And South Africa, of course, has a very strong and I think well-established community health situation. It has a very strong network of community health workers that it's now been able to deploy. There are problems that come up with that in terms of people refusing to be tested, for instance, who I think are worried about what it means for being quarantined or being taken away to be quarantined in government quarantine sites, things like that. But broadly, I think that community testing has actually been successful in the sense of it's now coming up against availability of reagents and availability of testing machines. The government's due to get an order of a couple of hundred new testing machines arriving in the next week or so, also of reagent as well coming in. But I think the other interesting question that has come up is on this is around testing versus other countries. It's true. I think South Africa has tested a far larger number of asymptomatic people now in recent weeks. That wasn't the case early on, of course. whereas a lot of other countries test, particularly in hospitals. There are also obviously death classification, morbidity classification problems as well. That's becoming a massive political issue in the UK, where basically anyone that dies who is suspected of having COVID in the sense of shortness of breath or things like that is classified as a COVID death, even if they don't have it, and there doesn't necessarily have to be testing. And I think that's why the full picture will emerge only over time, and it is far too early really to talk about the differences in any great detail between countries at the moment. There's then some economic questions around the recovery plan, sorry, I'm just trying to scroll through such a ginormous volume of questions around the recovery plan, and in particular about how this is going to be presented and when it's going to be presented. So we have only 2 dates so far. One is this SIDSA Sustainable Infrastructure Development Conference, which is on the 23rd of June. That's when a lot of funders and government and a lot of people who want to build infrastructure will get together for a big symposium. It's going to be a very exciting point, certainly, for this, though, as I think it's important to realize that there are a lot of underlying sort of chicken and egg problems around regulation, around PPP regulations, around capital budgeting in government and the systems of government to be able to do this kind of stuff. But it's a very big, important first step that's going to happen on the 23rd of June. And then Parliament has finally agreed today to the 24th of June for the emergency budget. Now, people, I think, always misrepresent what a budget is, whether it's in February or October. There's always sort of bizarre over-expectations on the finance minister to somehow solve all problems. Now, Trevor Manuel could do that in the past when he basically controlled economic policy in a much broader sense in the Mbeki government. But that isn't the case anymore. And actually, whilst we've had the Tito paper, there's a question asking around the Tito paper, the structural reform paper that Treasury put out last year. The Treasury has no ability to direct policy in the way maybe it did in the past. There was, of course, political pushback against that through the Zuma years, as there were a blockage on state capture. But even more recently, that's still a hangover, I think, in the ANC around around the role of Treasury. And it's never really fully been replaced as the problem. DTIC is much more micro fiddling, and we saw that in the level 4 regulations, which DTIC had control over. This idea you can prescribe to the economy what it does, very much coming through there. The presidency has not really taken over a larger macroeconomic or microeconomic general policy coordination role in a very active sense. They certainly are involved, but there isn't a sort of more holistic view. And the Presidency Economic Policy Commission is also, a talk shop is too strong a word. It certainly produces papers that are interesting, but is not really there as an active participant in the logistics of reform, if you like, and providing capacity in a very active sense around how reform can really be delivered. So we're expecting some much more general announcement of the reform package around the end of June. There's no date at the moment. The presidency just sort of promised that it'll be around the end of June. But then this will go into a big NEDLAC process and a big social compacting process, which will be very time consuming, to say the least, and distracting probably as well. There are people who want to completely reinvent the economy, which I think would be a very time consuming thing, and a distraction from some of the low hanging fruit, versus others, individual sectors, individual role players who have maybe much more meaningful and practical solutions to bring forward. So we see sort of a dual track, if you like, of a big headline, very, very noisy contestation through NEDLAC, etc., versus a lot more underlying behind the scenes work going on around individual reforms. And that comes to some of the questions there were on things like NHI and land reform and prescribed assets. Land reform will be, I think, not particularly part of this. It will be referenced a lot, certainly. There'll be a lot of PR around it. We've just seen this morning Parliament has now pushed way out the restarting of the Section 25 committee, maybe even into next year, when it will actually then finally report back. So there'll be a lot of discussion around that, but I don't think it's really fundamentally going to be part of the reform package. There's going to be a lot more driven around infrastructure in particular, network industries, things like that, easing the cost of doing business are going to be the key sort of factors, and how then you can push out particularly credit and marshal assets in the economy towards that. And that's then when the prescribed asset issue comes in. We don't see prescribed assets ever happening. We think the Constitutional Court would block it. People like ASISA, the Asset Management Industry Association, would block it through the courts. We think Treasury, who would be the ones who have to do this, wouldn't do it. But it's what we call a fallout risk. There is, despite the fact it will never happen, there is a huge amount of destabilizing discussion and potential steps forward, or attempted steps forward, on this policy, which will come up when I think you see the private sector not funding politically favored investment infrastructure projects, when you see this very slow pace of recovery coming through. Orin highlighted some of the numbers, but even 5.6% growth next year is actually really low. If you consider minus 10% this year, in level terms, it's very low output of the economy. And that's where a big fight, I think, comes around what banks and asset managers are really doing, and what investors are doing as well is going to become a very big topic of conversation. Is money being put to the right purposes? And that's where we see that debate certainly progressing, steps forward on it taken, but we don't actually see an ability for government legally to be able to do prescribed assets at the end of the day. And then on national health insurance, a few questions around that. We do see that happening, but again, it's in a similar way to prescribed assets. We don't really see an endpoint time frame being reached where you see a UK-style NHS free at the point of use, sort of broad central funding. We think you create a shell entity called NHI, which funds a few, maybe 10, has been mentioned so far, interventions, including things like community health, TB and HIV, but not sort of this big, broad conception of limiting the powers of private hospitals, price controls over private hospitals, disallowing certain sorts of medical scheme coverage for what's covered in the public sector. We don't see that happening within any meaningful time frame, actually. And so again, for us, it's one of these fallout risks, which creates a huge amount of noise, but actually much less movement in the short to medium run. Orin, if you just have a look in the questions for some to pick up on there, I'll just answer a last one and pass over to you. Important mention of the informal economy, a few questions around that, which is sort of a sort of pet topic of mine. I think when I bring in foreign investors to South Africa, there is people sort of go to shiny office blocks and sort of miss the large swathe of how most large part of the South African economy actually operates, and is sort of underrepresented in a lot of policy discussions around the reform and recovery period now. Even again, that mistake being made. And for me, in the long term, the way you solve the unemployment and the inequality crisis is really at the boundary between the formal and informal sector, and where the informal sector has, by definition, no or very low backstops and support nets. Now one attempting obviously to be introduced with the new SASSA unemployment benefit, but the sort of almost joke I had to double take when I read it, outcome, they only paid 9 people in its first payment round. Now probably this month it's paid about 350,000, I think it is, but 3.3, I think it was, million people applied. I think there really needs to be a focus on delivering capacity into the informal sector. But in particular, that bridge and that boundary between the informal sector and the formal sector is really how you're going to solve both the growth crisis, the unemployment crisis, the recreation of SMMEs, obviously more on the micro end in the informal sector. How they leapfrog into the formal sector is going to be incredibly important to actually benchmark of if the recovery can actually really be successful. And it's very hard to get data. I mean, I've been sort of chomping at the bit around a lot of the interactions through this crisis I've had for data on what's going on in the informal sector. It's very, very, very hard really actually track what's going on. Remember, a lot of the headline numbers of unemployment changes when I talk often about 2 million jobs possibly being lost. That's formal sector jobs. The amount of informal sector jobs through level 5, may alone have been 2 million. And so I think that we need always to be careful about language as well. A lot of data and a lot of focus is on the formal sector, and we certainly shouldn't forget about the informal sector going forwards. And that's where I think a lot of interesting things a lot of interesting focus is going to go on in the long term, thinking about how green energy can be pushed down into that segment. Very, very cheap energy is certainly something to watch, how you can build on-store supply chains. The informal sector has certainly a strong role to play in that. So I said a pet topic of mine in the sense of overlooked by many, but very crucial to what happens in the future of the South African economy. But I'll pass over to Orin to deal with, there's a broad smattering of questions to you, Orin.
Okay, all right, thanks, Peter. All right, so yeah, I think there are quite a lot on my side. So the first one there is, what do you prefer is the best shares to buy? I would just combine this. I think there was another question as well, which was looking at how do you select stocks? So basically at Intellidex, we are fundamentalists. We believe in fundamentals. So the way we look at it, we just use a simple top-down approach. It's not the only method. There are quite a lot of them out there, but that's the one that we normally use. So it's a matter of looking at the macro environment. Start with the global environment. How does the global affect South Africa? And then from there, you go down to industrial factors. So if you can get a very good example, I think in the travel and leisure, when you look at industrial factors, at the moment, that the sector is locked down. And then from there, you can drill down into individual stocks. So when you go to individual stocks, you're looking at company fundamentals. You're looking at their balance sheet. Is it strong enough? Can you sustain them through this difficult period? In terms of growth, are there any growth opportunities, for this particular company? What is it this company is doing, which is probably going to help it, come out tops in that particular sector? So that's generally the approach that we're looking at. And in terms of what, if you can probably refer to the last, the last slide that we showed, I think the companies that we think are less vulnerable, the ones that we had put in the defensive pot, I think those are the ones that at the moment least vulnerable to the macroeconomic trajectory that we painted. Then there was another question, I think, on which is referring to, I think I mentioned that there is sort of improvement in sentiments, and Sfiso was asking if it is a real improvement in sentiments, or it's just there is nowhere to hide. I mean, it's quite true, really, because generally when we've got safe havens, which are mostly bonds, quality bonds, and then we've got risk assets on the other end, which are equities. And what's happening is exactly what Sfiso is saying. The interest rates are low, so as a result, there's not so many opportunities for investors to go into. I mean, considering the fact that there's quite a lot of money which is pumped into capital markets through the various monetary policy easing. So there is truth in that, probably people are just going back to equities because, it's not really because they're expecting to do better, but it's because they've got nowhere else to go. But that, again, I mean, you mentioned Togo-san, that, it went up, was it 213%, as you mentioned? I think one of our colleagues was putting it on our chat yesterday as well. I was even astounded by, what was happening there. But at times, it's not because, they expect anything better. It will be just an adjustment of projections. So probably people expecting something worse, and maybe we get, some better news, and then you try to adjust your projections. That could be something that could be, driving, investors to go into some of these risk assets. Then there was another, Rashin, you're asking when is the expected dip on equities. So look, I mean, it's very difficult for us to pinpoint exactly, but I think what you can say is triggers, the triggers that we anticipating is high frequency data, because our view is that a lot of people are just focusing on coronavirus. You have good news tomorrow morning. There's an American company which is working on a vaccine, and it's sort of, getting a bit of strides in that, and then people are happy about it, and they start, being a bit confident to buy equities, and they go into equities, and the next morning you hear that maybe that vaccine is not going to work, and then so the sentiment is mostly driven by coronavirus stats, and they're not paying a lot of attention to the economic data. So what you're saying is when you start seeing high frequency data, if it's going to be worse than what people are expecting, that's when you're probably going to see a dip. If we're going to see earnings of companies, we've got a lot of trading statements coming through, and a lot of them are agreeing. Like if you look at the banking sector, which is saying, South African banking sector, which is saying that they're expecting earnings to be at least 20% below the previous period. So they're quite bad, but now when you go to share price, you might not actually see that instantly. So when that data comes and people start adjusting their views, their projections, taking that into account, I think that's when you're going to probably start seeing the dip. Then I would probably just jump to another one, which was looking at, I think there was a viewer asked about dividend ETFs. And so at Intellidex generally, I think our view is when you look at dividend ETFs, you'll probably find two types of dividend ETFs. There is one which focuses on dividend growth. So you'd find that the methodology is looking at the growth rates of dividends of certain companies as a screening indicator. Then there are others which use dividend yield. So generally what we're saying is focus on the ones that look at the dividend growth, simply because they're looking at a track record of the company, right? Dividend yield is dependent on the share price of a stock. So if you take, for example, when when stock markets are down, generally the dividend yields goes up, because the numerator? The numerator there in the calculation of dividend yield would have gone down. So it might actually give you some misleading numbers. So rather focus on the ETFs that looks at dividend yields. And I think a very good example probably that we are, which is our favorite as Intellidex. I think it's cautious DivTrax. It has got a very strong investment methodology there. Yeah, Peter, I think that's what I've seen so far. I don't know if you've seen it. Yep.
Yeah, there was a question on investing in government bonds, which I think is a very interesting question compared to what you've been saying on equities. On equities, you can obviously bounce around in a sense of a lot more options, whereas we've seen obviously very, very large shifts, particularly in the front end of the government yield curve as the SARB has cut rates, whereas the back end has stayed very, very high, and is now it's one of the steepest yield curves in the whole world. That's actually attracting capital into South Africa, but makes it very hard actually to invest. There's a huge amount of fiscal risk coming through. So, I mean, to answer the question, it depends why you want to invest, what your investment objectives are. If you're looking for a return, then yes, investing across the whole curve will give you a much higher rate than simply putting it in a deposit, if you can take some volatility. But if actually you're investing more strategically here, then we do worry on the sort of, if you like, the price action of bonds. It is actually a little bit more challenging, given we think there are these fiscal shocks to come. In particular, we worry around yields going higher in the next sort of 6 months. Basically, we think the government can fund itself quite easily for the first half of the year, but the second half of the year, we actually worry. There's been a lot of basically corporate money buying corporate cash that should have been invested in the economy has gone into government bonds, which will, we think, flow out through the recovery phase. And add to some volatility there. So a lot more optionality to sort of be flitting between different sort of equity sectors, and the sort of ideas that Orin was laying out on that front. And there were also some other general questions, I think, around risk here. And I think we've been surprised we've been surprised in general globally about how actually a lot of investors have treated this crisis. Most crises, people sort of get timing completely wrong, but we actually saw in US markets, for instance, a huge flux of retail investors coming in at the lows, even into the derivative markets. And this seems very unlike the 2008 crisis, basically, where retail investors did sit a lot in cash. It seems people are more involved, but I think that it comes down to your risk preference ultimately, and obviously the end point after some of the initial shocks after 2008 was that in a world of very, very loose monetary policy, you end up with these sort of range trades going on in all asset classes as people look around with so much easy money for where there are dislocations coming through and flip between them, and they all bounce between different ranges. And so the sort of conception I remember from the start of my career, pre-global financial crisis, you had these big, long structural momentum trades and things like that. Kind of probably is not the world we're in with such easy monetary policy. So hence some of the granular detail from Orin was very interesting, starting to think about relative value there. But I think we've hopefully at least covered a lot of the broad high-level substance of the questions, a huge volume of questions. Thank you very much. Yes, back to you, Sean.
Thanks so much, Peter and Orin. Yeah, thank you so much for answering. I think those are very insightful. I think you guys went into a lot of depth there, which hopefully our clients loved. So if we didn't get your questions, really sorry, but we think we got to most of them there. So thank you so much for taking the time out for joining us today. And thank you to Peter and Orin for joining us. Thanks again, guys. That was great. Have a great afternoon and stay safe, guys.
Thank you.
Thanks, guys.